Can you imagine clinching a deal worth $50 billion that changes the course of financial history? What if I told you that Bank of America pulled off the deal of a lifetime with Merrill Lynch's acquisition? In this video, we're diving into the high-stakes world of finance, where multi-billion-dollar decisions shape the future. Stick around, because by the end, you'll unravel the secrets behind this blockbuster acquisition and gain insights that could transform your understanding of strategic business maneuvers. In the midst of the 2008 financial crisis, one of the most significant events that transpired was the acquisition of Merrill Lynch by Bank of America. This $50 billion bet not only reshaped the landscape of the industry, but also sent shockwaves through the global economy. Bank of America, a powerhouse in the banking sector, traces its roots back to October 17, 1904, when it was founded as Bank of Italy by Amedeo Giannini in San Francisco, California. Over the years, it has grown to become one of the largest banks in the United States, with assets totaling over $2.2 trillion as of 2023. Merrill Lynch, founded in 1914 by Charles E. Merrill and Edmund C. Lynch, was renowned for its wealth management, investment banking, and brokerage services. By 2008, it had grown to manage approximately $1.6 trillion in client assets, making it one of the largest and most influential firms on Wall Street, with a significant presence in both retail and institutional finance. As the 2008 financial crisis, triggered by the collapse of the housing bubble and subprime mortgage loans, left Merrill Lynch on the brink of collapse, the firm faced staggering losses of $15.3 billion in the first 9 months of 2008, and had to eventually write down a total of $42 billion in toxic mortgage assets. As investor confidence plummeted, Merrill Lynch found itself in a precarious position. In a bold move to stabilize the situation, Bank of America swooped in to acquire Merrill Lynch for $50 billion. The deal was structured with each Merrill Lynch share being exchanged for 0.8595 shares of Bank of America stock, resulting in about 1.7 billion new shares issued by Bank of America, along with $7.12 in cash per Merrill Lynch share. This acquisition not only saved Merrill Lynch from potential bankruptcy, but also positioned Bank of America as a dominant player in the financial services sector. The $50 billion deal was one of the largest mergers in financial history, involving two of the biggest names in banking and investment service. Bank of America was one of the largest commercial banks, while Merrill Lynch was a leading global investment bank and wealth management firm. The merger combined Bank of America's extensive retail banking network with Merrill Lynch's strong presence in investment banking and wealth management, creating a behemoth with a vast array of services. The acquisition had immediate and far-reaching effects on the markets. Bank of America's stock initially saw a boost, with shares rising by nearly 7% following the announcement. Analysts highlighted the potential for significant cost synergies estimated at $7 billion annually, driven by the integration of operations and elimination of redundancies. This merger created one of the world's largest financial institutions, with combined assets of over $2.7 trillion. At the time of the deal, Bank of America was led by CEO Kenneth D. Lewis, known for his decisive leadership and strategic vision. Lewis had previously overseen several major acquisitions, including Fleet Boston Financial and Countrywide Financial. Merrill Lynch was guided by CEO John Thain, a respected figure in the financial world with a deep understanding of market complexities. Thain's leadership was crucial during the crisis as he worked to navigate the firm through the turbulent financial waters and secure a lifeline through the acquisition by Bank of America. The strategic motivations behind the acquisition were clear. Bank of America aimed to diversify its revenue streams and enhance its wealth management and investment banking capabilities. Merrill Lynch's strong presence in these areas provided Bank of America with an opportunity to tap into a new client base and expand its market reach. For Merrill Lynch, the acquisition offered stability and access to Bank of America's extensive resources, enabling it to weather the crisis and rebuild investor confidence. Both companies faced numerous challenges during the '08 crisis. Bank of America contended with its own exposure to the subprime mortgage market, which resulted in significant losses and necessitated a $20 billion capital injection from the U.S. government as part of the Troubled Asset Relief Program. Merrill Lynch, meanwhile, had to offload toxic assets, cut costs, and stabilize its balance sheet to regain stability. To navigate these challenges, Bank of America focused on bolstering its capital reserves and enhancing risk management practices. The company raised $13.9 billion through a public stock offering and implemented measures to streamline operations and improve efficiency. Merrill Lynch, under John Thain's leadership, embarked on a restructuring plan that included selling non-core assets and reducing its workforce to cut costs and stabilize the firm. The $50 billion acquisition was a high-stakes bet that reshaped the economy. Bank of America's willingness to take on Merrill Lynch's substantial liabilities was a bold move aimed at creating long-term value. The implications of the deal were profound. In the immediate aftermath, the combined entity saw enhanced capabilities in wealth management and investment banking, leading to increased market share and client trust. Long-term, the acquisition positioned Bank of America as a dominant force in the financial sector, with assets under management exceeding $2.8 trillion and significant global reach. Stakeholder reactions were mixed. Some praised the deal for its strategic foresight and potential to drive growth, while others expressed concerns about the integration challenges. Analysts highlighted the potential for cost savings through operational efficiencies, but warned of the difficulties in merging two large organizations with distinct cultures and systems. As we've explored, the $50 billion acquisition was a pivotal moment in history, saving Merrill Lynch from potential bankruptcy and reshaping the global economy. By merging its investment banking and wealth management expertise with Bank of America's extensive retail banking network, the deal created a dominant entity capable of competing on a global scale. Today, the combined force of Bank of America and Merrill Lynch stands as a powerful example of how bold business decisions can redefine market dynamics and shape the future. Thanks for watching our exploration into how Bank of America scored the deal of a lifetime with Merrill Lynch's $50 billion acquisition. If you found this billion-dollar tale to be insightful, please like, share, comment, and subscribe to our channel. Your engagement fuels our mission to bring you more captivating stories about the world of billion-dollar businesses. For another billion-dollar tale on how Sidney Weinberg rescued Goldman Sachs from the dot-com crash, please click here. Stay tuned for more insights and stories that shape our world. See you in the next video.